Hello, welcome back. So I think I might have been disconnected. Anyway, so I'm going to share my slides. Okay. Alors, so as I said, so I'm Jean-Marc Seigneur, director of the Certificate of Advanced Studies on Blockchain Development at the University of Geneva. We are going to have 3 speakers today. So Lisa from Economics Design, based in Singapore. Then we'll have Dante from Circle in the USA, and Gueorgui from Luxembourg. So just to give you a bit of feedback. So sorry, I mean, I'm not sure if everybody hears me here. Is it okay on the ITU side?
Yes, Jean-Marc, we can hear you. Please go ahead.
Okay.
We can hear you. Thank you.
There was a technical issue, I think, at the beginning, so I was not sure. Okay, so just as a bit of background, so as I said, the Blockchain Certificate of Advanced Studies at University of Geneva is taught online via Zoom in English. And you can find more information on this website. Today, so we are going to start by an overview of the work that we have done as part of the Digital Currency Global Initiative, partnership with the ITU on the stablecoins. And then each speakers will speak around 15 minutes, presenting specifics of this domain. And we'll have an open panel question and answers with you in the audience, and then we will conclude. The key takeaways of this session will be around so the notion of a stablecoin, so what they are, how they differ from central bank digital currencies, what are the main regulatory challenges, and also we of course will cover some technical aspects and where standardization can be useful. So the work that we did on the stablecoins work stream as part of the DC³ started in mid-2020. And we have already published a first version, a draft version of the report that you can find on this link, where so we define stablecoin and covered a good number of use cases of existing stablecoins, as I am going to present here. So we started by a state-of-the-art review, and there were many different models and taxonomies of stablecoins. So, for example, here from the Bank of International Settlements, and another one by Moine et al. In 2019. And from the beginning to the second one, we see that the number of types of stablecoins change a lot. So from maybe 2 categories and subcategories, we went with more and more different types and subcategories, because the types of stablecoins started to become more and more different, and the types varied from stablecoins with collaterals or algorithmic stablecoins, as for example Lisa will present afterward. But so what we decided is that because actually the stablecoins is still a new topic, and there are more and more types that are created along every year. So we wanted to have a simple definition that can cover all these types. And then here you can see the results of definition, which is pretty simple, which says that a stablecoin is a coin which is stable relative to a reference. And this reference point can be of different types, as we will see. So of course, at the beginning, it started with to be stable with, for example, fiat money, a reference value of government money, it's stable against $1 or €1. And afterwards, other types started to be proposed, like, for example, baskets of assets, or even like some others based on other reference points, like based on algorithms. If we look at the first types that were created, so they were more collateral-based stablecoins, meaning that the value, for example, which is said to be like stable against $1. When you have one token equals $1. Was possible because there was a reserve of real dollar in the system. So there was a reserve of fiat money, government money. Other types of collaterals then after were like created and added. So for example, commodity-based collaterals, gold, for example. And some of these stablecoin types were also using collaterals based on cryptocurrencies. So, for example, Bitcoin were used as collaterals, or Ethereum, or different types of cryptocurrencies. And so the main difference when a stablecoin is supposed to be equals to $1 compared to a central bank digital currency is that then you have a trust issue. Because when you have a central bank digital currency, for example, the United States of America, which says that one token is equal to $1, they are creating the currency, they are printing the currency. So you are sure that this is, if they say this is equivalent to $1, that it will be for sure. One token equals $1. But when you have a private company or an entity that is saying the same thing, that one of their token equals $1, you have an intermediary. And so then you will have to trust the intermediary that there is enough reserve to be sure that your token equals $1. And then, so you have this trust issue. So the main difference is that there is a trust issue. When you have a CBDC, there is no trust issue. When you have a fiat-based stablecoin, then you will have a trust issue about the reserve. Some of these stablecoins with fiat-based collateral are quite well known. So, for example, you have USDT. So Dante is part of Circle, which provides USDC. Now you have some other ones which are based on Euro, for example, or we covered also ones based on Brazilian real. We covered also the baskets of fiat currencies. So, for example, it was stable to here not $1, but for example, a purchasing power. So you had a basket that was supposed to be stable with regard to purchasing power. And in the report, you will find more detail about all these different collateral-based stablecoins. Of course, some of them, as I said, are more or less trusted and more or less trustworthy based on the transparency that they provide, the links that they have with the official banks and the governments, and the reports that they provide, like audits. Then we have also these collaterals based on crypto, like MakerDAO DAI, Celo CUSD that we covered in the report. And then we are expanding the number of use cases, stablecoin use cases that we cover in this DC³ report. Of course, USDC will be added, and we could also cover UST, which is a new stablecoin, quite newer, but where, for example, other providers like MakerDAO say that their system may not be so stable in case of a big crash. We covered also one algorithmic stablecoin. So Lisa is going to give more detail about these types of stablecoins. You see that, as I said, there are more and more types that are created along the years. So then it's reason we are expanding the list of use cases, and but still the simple definition that we had can still apply. So we had many different aspects which we used in our comparison of these different stablecoins. I will let you check the report. And this report also covers legal aspects that actually Gueorgui at the end of our session will discuss, and interoperability, because from a standardization point of view, if you have a standard, then a worldwide standard, for example, provided by the ITU, the international organization, it's easier to have interoperability because you can rely on this standard to make, for example, stablecoin interoperability between all these different stablecoins. So I think now it's time to introduce so the first speaker, who is Lisa Tan from the Economics Design, so based in Singapore. Lisa, please. So just to give a bit of a background about you, so you are an expert in tokenomics. So these economics based on cryptocurrencies, tokens, and in our case, stablecoins.
Thank you, Jean-Marc. Let me just share my screen and we can get started. Well, good morning, good afternoon, good evening to everyone. Today, we're going to talk a little bit more about the monetary policy and understanding, doing a little bit of empirical understanding to compare the price stability given the various kind of monetary policy. So what is the goal that we're looking at over here? Firstly, stablecoins are privately issued currency with their own monetary policy. In fact, on Bloomberg just today, Facebook is selling their stablecoin arm, which is DM, and they want to disassociate themselves from the project Meta. A lot of projects, a lot of companies, privately corporations or different organizations are issuing their own privately issued currency. So let's take a step back to understand what is currency. When we talk about currency, we have two big types. We have free floating currency and we have pegged currency. And within pegged currency, we have crawling currencies. It changes within a certain bandwidth, and then we have stable coins. And within stable coins, we have privately issued stable coins, and we have CBDC, central bank issued stable coins. And here we're going to compare just the privately issued stable coins, the ones that is issued not by government, but by corporations or by an organization. So what do we mean by pegged currency? Here we're talking about there is a price stabilization mechanism. There's either a treasury risk management or a model risk management to maintain that peg, to maintain that stability. So we're going to look at how do they, and all of these are basically monetary policy in an organization or in this in this token. So what we want to look at over here is that how does the various monetary policy mechanism creates the most stable prices? In the past, in the year of 2021, we have a lot of different tokens being issued, a lot of tokens being experimented, a lot of various kind of monetary policy, as well as increased usability by people, by the general public to trade these currencies more. So 2021 was actually a perfect time to collect empirical study, to collect data and results, to start analyzing these stablecoins a little bit more. As an economist, it's always very interesting to have natural experiments and then take the empirical data to make some analysis. So we did some analysis and we'd like to share that with you. So we're going to talk about three things today: the monetary policy of stablecoins, the crash stability analysis, the price stability analysis given monetary policy, as well as given all these different insights, what can we get out of it? We're looking at what are the fundamental drivers of stablecoins to be crash resistant. So, and the various monetary policies, we're looking at 3 types. Jean-Marc has explained a few of them, and Jean-Marc has also classified the various kind of stablecoins, the various kind of monetary policies. We have shifted in 2017 with 3 types, which is on-chain reserve, off-chain reserve, and algorithmic, to what we had in 2019, where there was a paper that's written talking about more ways of classifying stablecoins, because stablecoins are a lot more robust now. There are a lot more different mechanisms or new technologies to allow us to play around with newer monetary policies. And at the end of the day, monetary policy is just one of these risk management tools, or one of these management tools to help maintain the inflationary and deflationary pressure of your entire economy in which transactions are made with stablecoins. So having this tool is going to be important in maintaining the robust growth of your ecosystem. And that's why monetary policy is important. That's why all these mechanisms to create this stability is very important, because you don't want your economy to be overinflating. Another news that happened today was Venezuela, where the price is inflating so much that people are literally burning the notes. So we don't want that kind of situation in an economy, be it digital or physical. That's why we care about monetary policy. Today, if I can just classify monetary policies into 3 very, very broad categories. The first one is reserve-based. It could be off-chain reserve or on-chain reserve. So that means an asset is backing another asset, and it's usually 1-to-1 because it's purely reserve-based. $1 in your bank, you create 1 USDC. $1 or $1 equivalent in a protocol, you create a stablecoin protocol. Algorithmic is where it's purely algorithmic. So there's nothing backing it. There are different mechanisms to be trading different assets, but it's not backed by anything. This is where we have UST, we have AMPL, AMPL, and BAC. And then we have a mixed policy. So this is the new category that's carved out, where it mixes both. It mixes both reserve-based and algorithmic, where reserve-based is always 1-to-1. Mixed policies is where you have different mathematical functions, which is algorithmic, and mixing it with the reserve-based. So you have a mix of different mechanisms, and these becomes your risk model or your treasury management model to maintain the circulating supply of your stablecoins. So what we did was to compare against all these different stablecoins, because they have different kind of policies. We look at price correlation, we look at price stability, and we want to see what kind of insights can we get. Based on that, we can have better insights of what kind of monetary policy might work. So let's take a first look at price correlation analysis. So here we showed what you're seeing over here is a correlation matrix between stablecoins. And what can we see from here? So the A part is the one on the left is correlations of stablecoins in the entire year of 2021. And B, the table B, is just the month of November. So we want to show these 2 differences because the whole year of 2021, we had a lot of stablecoins being created, more people are trading. November was the part where we had a lot more intentional transactions or a lot more volume and velocity of transactions. So we can give a little contrast. But what can we see overall? We can see that on average, stablecoins appear to be more correlated in November 2021, so the chart on B, than the chart on A. And why is that so? So you can see that by you see all the blue numbers in the box. That's the darker the blue, the more correlated they are. So what does this suggest? This suggests that the stablecoin market is growing, and stablecoins are more mature and widely used. Hence, the prices are more correlated. Why is that so? So you have more circulating supply for arbitrage. You have more utility of people using and trading and transacting, which increases velocity, which increases utility, which increases the stickiness to using the stablecoin. And November was a month where the market was a bit more of a bull market. There's some variations in prices, but a lot of people were trading, a lot of people were using, a lot of people were transacting, new people are entering the space. And hence you have more correlation in these various stablecoins. The second thing is that the correlation is highest between fiat-based stablecoins. So if you look at the bottom right of the chart B, the colors are very dark, and these are BUSD, USDC, and UST. So these are all fiat reserve stablecoins, which means technically or theoretically, you have $1 in the bank account to create one stablecoin or one crypto version of USD to be circulating in the space. So what we see is that in the month of November, in fact, the other months as well, you have very high correlation between these different assets. And why is that so? We can attribute it to point number one, which is the growth in market size. So when there's a growth in market size, new people are coming into the space, new people are entering. And when you're entering the crypto space, there's so many tokens to play around with. There's so many tokens to be using. Sometimes some people are more comfortable with bigger stablecoins, layer one stablecoins like Bitcoin, Ethereum. But there's very high volatility that if another person who is less risk averse and wants to enter the space, what is the entry point? The entry point is usually stablecoins because you have less volatility, it's easier to trade, it's safer to hold. And hence one of the general methods or general behavior that we see is that as new people enter the space who are less risk averse and generally knows the space a little bit, it's more likely for them to hold stablecoins because of the fear of volatility. That increases utility, that increases usability, that increases market size of the token. What do we mean by increasing market size? It just means that there's more circulating supply of tokens, there's more usability of these tokens, and that in general increases demand of these tokens. The other thing that we also noted is that DAI, which is an on-chain collateral stablecoin, also has significant correlation between the large fiat-based stablecoins. And what does this mean? This shows that DAI is the oldest on-chain stablecoin of the entire data set that we have. And because they are widely used, again, increased market size, people are likely to hold it. Who are the people who are more likely to hold DAI than USDC? So some people could be, they are very into the whole DeFi philosophy. It's all about decentralization, nothing to do with KYC, nothing to do with AML, or just having their privacy behind the different cryptography codes. And they're more likely to use DAI to be transacting. Also, if you're in the DeFi space, a lot of these pairs, all of these transactions can be done mainly in DAI, or a lot of people accept DAI. So it's not unlikely for someone that is DeFi native, decentralized finance native, to want to hold DAI a lot more than holding USDC or UST, for instance. DAI is also the oldest, so it has the largest market size, the largest network, and largest velocity in terms of all the other on-chain stablecoins. And what do we also want to see from this correlation matrix is that if someone wants to diversify the risk by holding stablecoins, it's also possible to hold stablecoins with these varying kind of correlations. And lastly, the thing that we see is that AMPL, Ampleforce, and BAC, they have the lowest correlation of all the major stablecoins. And they're almost uncorrelated to a certain extent. So the most direct reason to explain that is that these two are purely algorithmic stablecoins, and their utility is a lot less, or the usability and the demand and the network is a lot less than all the other coins. So if we go back to the previous slide, we see that UST, AMPL, and BAC are all algorithmic stablecoins. But why is it that UST is performing so different as an algorithmic stablecoin than AMPL and BAC? The reason is very simple, because in UST, who is using UST? You have the on-chain demand and off-chain demand increasing the demand of UST because of how the entire UST ecosystem is created. Whereas AMPL and BAC they're just issuers. They're just issuing tokens without creating an entire ecosystem around it to increase the demand of tokens. So we're going to talk about that a bit later in the last part, understanding the fundamental drivers to be crash resistant. And this is a very important fact. And we can see that in the numbers where UST has a very different correlation between Ampleforce and BAC. But let's go to the next part on price stability, to understand a little bit more about how does the monetary policy impact price stability, because that's our main goal of this session. So what we see over here is the empirical distribution of price of stable coins deviations from the $1 peg. And just to look at these charts, just these charts alone, what we see this needle-like shape. And what we want ultimately is a very thin needle and very, very short needle. This shows that there's less volatility, less price changes, less movement in the pricing. So when we look at a very tall needle with a very fat bottom, this means that the prices are very volatile. Volatile means that prices change a lot. And this is against what the whole idea of price stability is. Price stability is where prices are stable, which means you want a very short needle and very, very thin needle at the bottom. So in general, the needle just shows the frequency of changes. So from here, we can see that HUSD, BUSD, UST, and USDT. They're very tall and long needles. So it shows that it has frequent changes in hence the tall needle. And when we have something, the bottom that is very fat, so let's say HUSD, GUSD, the bottom is very fat, it shows that there are a lot of price changes around that $1 mark. So what can we see from here? Firstly, we can see that HUSD, UST, all the tall needles, they have very frequent but small price deviations compared to the other stable coins. GUSD over here, which is much shorter but very wide bottom, they have mid-sized price deviations. So the prices don't change as much frequently, but the prices deviate quite a lot, which is our wide bottom. And GUSD and UST have very high volatility. So when it comes to GUSD and UST, talked about UST before because it's algorithmic stablecoin. GUSD is Gemini dollar, which means $1 in the Gemini account, in the Gemini bank account, equals one circulating supply of GUSD, the crypto version of USD. So it is quite interesting to see this variation in GUSD because every circulating supply of Gemini dollar is backed by dollars in the bank account and is also audited. So that's quite interesting to note that there's such a big price variation for these kind of fiat reserve stablecoins. On the other hand, for UST, it is quite understandable because it's algorithmic. So to give you a context of how UST works, for every one UST that's circulating out there, it is not backed by anything. However, you can redeem UST for another token called Terra, which is the main layer 1 token for the Terra network. So it is not backed by Terra, but you have the right to exchange it for Terra. So why would people do that? When UST is falling very much and UST's prices are deviating too much, then you don't want to hold UST anymore because UST's prices are volatile and you lose value just by holding UST. So they have the right to sell it to buy Luna, which is the main token for the Terra network. And why would anyone buy the Luna token? You buy the Luna token because it is the driver of any transaction that's done on the Terra ecosystem. So there is this two kind of demand forces when it comes to UST and Luna, and balancing that will be very important, will be a key success factor for the monetary policy of UST. On the other hand, we didn't show the other stuff on BAC and Ampleforce because the prices are not stable at all, and the analysis will be way off the chart. But with the two other algorithmic stablecoins, they do not have an ecosystem to support the demand of both the stablecoin or any underlying secondary token in your entire ecosystem. And when you don't have the demand, you don't have any internal demand demanding your stablecoins, everything else would just be part of speculation. People speculate that prices go up or down, which is the main demand driver. And this is not the most robust mechanism to create stablecoins. So, and lastly, we can see that DAI has the closest volatility to USDC. So again, just a quick recap, DAI is the on-chain stablecoin. It's the oldest and the biggest and the most dense network of stablecoins. And they have the closest volatility when it comes to USDC. So they're both much shorter in the needle height, and in the width, it's a little bit less wide. However, its mean trades at above $1, the $1 peg, and it constantly trades above the peg. So that's an interesting insight. So what does that mean? What does that mean at the end of the day? At the end of the day, one of the most important things that we want to see is understanding the fundamental drivers of stablecoins. And in economics, we always look at supply and demand. So let's take a look at what does that look like in the supply and demand aspect. When we look at the monetary policy aspect, is really the supply function. So there are a lot of different ways where we can increase the token supply, which is defined by the monetary policy. Think of it as the monetary policy or the monetarist or the economist being the gatekeeper. You get to turn different parameters of how your economy is going to work. And there are a lot of different drivers of that. We can increase the fiat collateral, we can increase the underlying on-chain collateral. So instead of 1-to-1 or 100% backed, it could be 120% backed or 90% backed. Similar to the reserve ratio for banks. And the other thing for a lot of on-chain stablecoins where you have the dual token, the price volatility of the secondary token can also impact the supply quite a lot. And these are different things that the central bank or the smart contract can control. On the other hand, for the demand, we're looking at off-chain utility, on-chain utility, and on-chain utility in the wider ecosystem. So for off-chain utility, this is where UST comes in. When we talk about demand, there are primarily two kinds of demand. You have the intrinsic demand and the extrinsic demand. The intrinsic demand is the real demand that's used in your system, anything that's related to your ecosystem. The extrinsic demand is a little bit more about things you cannot control, like speculation. We can control the extrinsic demand. We can control speculation. So that is something that we'll just leave it to it. However, what we can control is the internal demand. And if we can nail this down, the proportion of speculation versus real demand will tip. So we want, the ultimate goal is to increase real demand, and speculative demand will have a less variable or less impact to the entire demand function. When we look at the off-chain utility, we're looking at UST, and what UST has is that it has this, it's being used in the on-chain function or in the entire ecosystem, but it's also used in the off-chain world. Like you could buy things in Korea, in UST, or in the crypto Korean won that they have. When it comes to the on-chain demand, we're looking at within your ecosystem, can you get people to be using your tokens more? And this is very similar to CBDC or a central bank issued currency, because if you're in the US and the way to be doing any transaction is to pay in US dollars. And so the government almost mandates your utility or any transactions using that native tokens that they issue. So how can we take this concept into the digital space? So you have different kind of tokens that is used within the ecosystem to be trading in that ecosystem. So for example, USDC is used in various kind of ecosystems like Coinbase, where you can do your transactions in USDC and you can transfer USDC into your fiat USD in your bank account. And that's the main utility, or that's one of the big utility of USDC in your system. And this increases demand. This increases real demand of your platform or of your token. And lastly, it's the on-chain utility in the wider aspect. So if your individual own ecosystem it's not enough to sustain the demand of your token, what about relying on the wider ecosystem? That's where DAI comes in. So DAI is used in a lot of the wider ecosystem. Let's say in the DeFi space, in decentralized finance, a lot of trades are there. A lot of pairs are done with DAI, or it could be done in the off-chain world as well. So DAI is used in, I think, Red Cross. You can do donations in DAI. So this helps to balance the demand, not just within your ecosystem, outside your ecosystem, and in another platform, so off-chain. So what are some considerations that we should just also think about, which could be the fundamental drivers of stablecoins? The first one is a base currency for trade. So UST, despite all the controversies, UST is actually a big base currency for trading Bitcoin. And it is also generally used as the currency for arbitrage for Bitcoin. So there's a big analysis on that, looking at the utility of USDT for trade, and that really increases the demand of that. However, this is a very special and unique case. It could potentially be because USDT has been in the market for quite a significant amount of time as well. The third thing is price volatility of.
Wait, thanks for your detailed overview of the fundamentals of the stablecoins. We are close to your time for the presentation. You have some question and answers in the Q&A in Zoom, and everybody else can also ask questions in this Q&A. So please, maybe if you want to just conclude, and then we will have time afterwards to answer other questions at the end when all presenters have presented. Thank you.
Perfect. So just to summarize, these are some other considerations to think about when looking at fundamental drivers of stablecoins. They're not just supply and demand only. And just to conclude, so I do a lot of research and then we run consulting, we do analytics, and we do a lot of empirical research. So a lot of research are shared on YouTube, and we do a lot of reports on that. So feel free to check out our YouTube on that, and feel free to connect with me if you have any more questions. Thank you. And back to you, Jean-Marc.
Yeah. Remember to check the Q&A because you already have one question for you. Now we are going to have the second speaker with Dante Disparte from Circle. He has already a long history in stablecoins because he was also part of Libra that was based initially in Geneva and now moved back in the US as DM. Dante, are you here?
Ready when you are, Jean-Marc, and thank you very much to Lisa for the preceding presentation. So I have a discussion here, given the experience, frankly, that Jean-Marc outlined of coming from the Libra project to now joining Circle. Circle is the leading issuer of USDC, basically one of the world's fastest growing, if not the fastest growing dollar digital currency in circulation today. But what I thought would be helpful for the audience and the participants is a conversation about how do stablecoins interplay with central bank digital currencies and sort of what is the emerging summary around the planet. So I'll try to do this swiftly and leave some time for questions at the end. And the principal thesis here is that not all money is created equal. So we'll cover a couple of things quickly. What is money? What are central banks thinking? And then are these types of innovations that Lisa just outlined and that I will share here in my presentation competing with the financial system, or in fact completing it? I think that's a central conversation that we have to answer. In fact, you could argue that much of the work amongst central banks around central bank digital currencies is born in no small measure for fears of big tech domination of how money might move, my former project, and the advent of international competition and geopolitical competition for the movement of money. So what is money? Money, according to economists, has really three properties, and this has been something that has defied early crypto projects, is a store of value, a unit of account, and a medium of exchange. When you consider this as the measure, we have to recall that most of the world's, virtually most of the world's population are subjected to domestic hyperinflationary currencies. And so in many cases, the very public good that we're describing here is not worth the paper it is printed on in many countries around the world. And that we also have to remember that cash still is king. 60% of all the world's transactions remain in cash. So despite the fact that companies like Circle are uploading cash into a cryptographic form on public blockchains, importing the powers of the dollar onto, of the internet onto the dollar, cash remains one of the most important mediums of exchange on the planet. But there is this important question. Is it really your money when it's added into the financial system, irrespective of the form, if you have to ask someone to spend it and pay someone to hold it for you? And frankly, I think one of the more powerful attributes of this now 12-year-old sector, blockchain-based finance and digital assets and cryptocurrencies, is this notion of democratization of that power. And what I like to describe as user-controlled, user-directed payments. This is one of the strongest arguments, for example, for the concept of self-hosted wallets and the ability to have much more authority over your money, including in digital form. This is one of the reasons I think, frankly, public policy has been very strong in its reaction, is because if these things could in fact scale, what would they then do to monetary policy transmission and other hard questions? So how have central banks responded to the development of this novel industry now 12, nearly 13 years later, and the fact that blockchain finance has gone mainstream and has started to collide with Wall Street and other traditional financial institutions? Well, the first thing traditional finance did was to try to create a taxonomy, and I apologize, some of these slides are a little busy, but to try to create a taxonomy in which digital currencies could be situated alongside other forms of cash and other forms of highly liquid assets in circulation. So this is the money flower from the Bank for International Settlements. Each one of the petals or diagrams captures a form of money, and central bank digital currencies would be in the middle, and cryptocurrencies and cash and commodity money would be right around it. So this is just to situate us in terms of how the central banks and how the Bank for International Settlements are looking at a taxonomy for understanding where these new innovations might sit. Of course, another interesting development, and this is from our colleagues at the Atlantic Council's Geoeconomic Center, is that not surprisingly, and you could point a date and time in which these innovations started to suddenly become of interest to central banks. Something like 90% of the world's central banks have a CBDC or central bank digital currency research project, either in a pilot stage or in some form of research and analysis. So what was once upon a time a very abstract concept amongst financial and monetary technocrats suddenly became a major public policy response for the advent of competition and geoeconomics with digital currencies. And here you have from the Economist a quick snapshot, the Bank for International Settlements, you have a quick snapshot of how central bank digital currency sentiment changed. And unsurprisingly, in 2019, there was a certain project that was announced that garnered quite a lot of global attention. And at that point in time, obviously, suddenly the interest in central bank digital currency went from negative to positive. And then you started to see this acceleration of the public policy debate on the future of money in the internet era. Fast forward through to now the third year of the COVID-19 pandemic, and we've, in addition to changing public sentiment and regulatory sentiment towards central bank digital currencies, you also see this question of what can we do and not do, but for technology at the core of things like household continuity, economic and political continuity. And so unsurprisingly, the COVID-19 pandemic may have accelerated at least a decade or two of digital adoption across sectors, including in finance, payments, and banking. The challenge, however, and this is where we transition over into a private sector conversation as well about stablecoins, is that despite the fact that there's a general agreement and an increasing positivity amongst central bankers about central bank digital currencies, the form factor for what a central bank digital currency could look like, whether it's an account-based approach or a tokenized approach, a claim-based or a liability-based approach, and so on, is far from having an official blueprint. Perhaps that's one of the outcomes of all the exploration and experimentation, but you're also starting to see, including, for example, amongst many countries, the UK House of Lords, for example, recently conducted a study on the merits, risks, and opportunities of central bank digital currencies and found that there was no real public policy opportunity for launching a central bank digital currency. So the debate continues into 2022. But to be clear, the form factor for what this money would look like is far from settled. And of course, the question then becomes, can the attributes that central banks themselves would like of money, either in physical form or in digital form, be rendered with privately issued digital currencies or stablecoins? Our view, of course, at Circle is that the fact is yes, and the fact ultimately is that this prototype, although the internet rails on which they ride might be in their dial-up phase, the fact remains privately issued digital currencies are supporting trillions of dollars in economic activity. And that's part of what is driving the growth and many of the economic points that Lisa outlined at the opening. And so here, I think, is a quick snapshot. And I think the main important point to take away is If you look at cash on one axis and you look at crypto assets on the other, entirely decentralized crypto assets such as Bitcoin, one of the important distinctions among them has absolutely nothing to do with technology and absolutely has to do with this question of legal tender status. Can privately issued digital currencies, given certain criteria and certain design attributes and prudential standards on bank-like risks, can they be afforded digital legal tender status? And so one of the major digital currency projects in circulation around the world, which will gain much more attention with the upcoming Winter Olympics, is the People's Bank of China ECNY experiment, which will of course be afforded digital legal tender status. And so that to me is the most important public policy question, much more so than the technology or the form factor of money in its digital form. And so another important question, because many often in these types of conversations describe cash as being dead. But the last time I was on a major panel with the Bank for International Settlements, one of the colleagues on the panel said, if you came to a regulator today with an innovation called physical cash, it's likely that innovation would not be authorized because of really a couple of factors. Its opacity, the physical limitations in that you and I could only extend it as far as our hands can reach. And then finally, in the context of a public health emergency, cash ultimately could be a vector for spreading a disease. And so in some countries at the onset of the COVID-19 pandemic, some countries actually resorted to physically laundering their money for fear that it would be a vector for spreading disease. But in many economies around the world, the circulation of cash actually continues to grow at a relatively steady pace, while in others like Sweden, which of course is advancing its digital currency efforts under the Swedish Riksbank, the use of cash is declining. There's also a series of important global and geopolitical concerns. Too many to really dive too deeply into in this conversation, but many of the potential risk concerns that I think should be deeply discussed with central bank digital currencies is the specter of privacy and censorship risks, is the notion that to the right of lawful, the use of money in all of its forms should be as free as possible. But there's also a really important point that people often forget, which is that for a central bank to issue a CBDC, the central bank fundamentally has to then be in the business of picking technology winners and losers and making a 100-year investment. Lastly, I think central bank digital currencies often ignore the fact that 95% of all value-added money in circulation around the world is already privately issued. The advent of stablecoins like USDC is merely uploading the form factor of that exact paradigm for how, and then enabling it on public blockchains. Always on digital economy would be the way to describe it in a nutshell. This slide is incredibly busy, I apologize, but it will be available to conference participants, is that when you think about money and you think about money in all of its forms, there's a series of attributes on the left-hand column that money should afford: scalability, acceptance, ubiquity, settlement finality, and so on. And so when you think about these types of general attributes of money and general attributes of payment systems innovations, can they be met and by a host of different innovations? And so a stablecoin breakthrough is really a breakthrough in providing price parity, solving one of crypto's earliest challenges, which is the question of buyers and spenders' remorse. Bitcoin Pizza Day and spending $80,000 on pizza is a teachable lesson in hyper volatility. A stablecoin like USDC that has economic parity to the dollar is increasingly a payment instrument and increasingly being enabled across even traditional payment networks such as Visa, MoneyGram, and many others. So then when you think about the geopolitical questions that then follow the world of always on money, and I think this is, perhaps the policy conversation to come, is what does this then mean? Does crypto equal circumvention of rules and circumvention of financial crime compliance frameworks? Or is there a counter narrative in which the ability to track and trace money flows, perhaps even in a world where the wallet address is pseudonymous or anonymous, does that start to put the penalty of illicit activity on the bad actor and not penalize every actor in the system? We have to remember we live in a world with roughly 3 billion people who are on the margins of the formal economy, and that itself is a source of risk. And for me, one of the things that motivated my entry from the Libra project now to Circle is the opportunity that if we can create a compliant payment endpoint in any internet connected device on the planet, we would then have the ability to extend the perimeter of the formal economy, reaching billions of users that are otherwise on the margins. So I think there's a lot to be gained here. And the COVID-19 pandemic really demonstrated yet again that without technology, the ability to move money, the ability to have anything close to continuity, including today's event, would not be possible. And so we now have a chance at doing that with this third generation of the internet, the so-called Internet of Value, where Web 1 was to read content, Web 2 is to read and write content on the internet, and ultimately Web 3 presents an opportunity to read, write, and own, and have digital scarcity and digital assets that are also trusted. We're only in the early innings of that innovation, but I'm reasonably confident this body of work will help produce a much more secure world and potentially extend opportunities for prosperity that you and I might take for granted because we were born in the so-called right postal code. So do these innovations produce competition or completion? In our view, the ability to have always on money and the so-called Internet of Value can complete unfinished work in the financial system. After all, if to be banked requires brick and mortar infrastructure in the same way that if to have access to telephony and low-cost communications required fixed line infrastructure, then there would be billions of people who were outside of the realm of internet connectivity and currently outside of the realm of banking. We think digital currencies are part of that puzzle, but technology doesn't on its own solve these problems. What technology does do, however, is it shows us where incumbents, policy, and regulations have fallen short. And I think that's one of the reasons the Libra project galvanized so much attention around the world, is because people and markets and central banks took the effort very seriously that it could reach population scale. And so, to some, in the US currency, the terms "in God we trust" are emblazoned on the currency, whereas in this new generation of users, people born with instant gratification and an iPhone in their hands, if they were so lucky, in code they trust. And that's part of the premise of what these innovations ultimately mean. With that, there's an opportunity, and the use of USDC as a dollar uploaded onto the internet, there's an opportunity to not only have fundamental trust of the dollar, but also candidly to amplify US monetary policy in a manner that's consistent with having the preservation of privacy and what I call the air gap between the central bank, your wallet, and your money and how you spend your money is an important feature, not a bug. So I'll stop there. Hopeful that this presentation was helpful and shed some light on some of the policy implications of these innovations. And looking forward to taking any questions that you might have. Thank you.
Thanks a lot, Dante, for your very interesting presentation. So at a higher level, so we had Lisa with economics details, very focused, and Dante here is more like at the higher level between CBDC and stablecoins. But then at the higher level, we also have the legal aspects. And this is the last presenter for this session, Gueorgui from Luxembourg, from KOHLER and Gotzev Law Office. Please, Gueorgui, so tell us more about these legal aspects of stablecoins.
Good afternoon, everybody. Thank you, Jean-Marc, and everybody at the International Telecommunication Union for inviting me to speak on this panel about the current legal and regulatory aspects of stablecoins, along with my fellow panelists and industry subject matters, Lisa and Dante. By way of background, I'm a financial markets and electronic payment systems lawyer, and I take care of advising licensing and regulation of financial market service providers, mainly within the European Union. And as a tech enthusiast, I also advise fintechs and crypto asset service providers on strategy and staging of their licensing with financial service regulatory supervision bodies in Luxembourg and Switzerland. I'm honored to be part of this panel and share my thoughts on the observations on such an exciting topic as legal and regulatory aspects of stablecoins, which have kept international and national organizations and governments very busy on policy implications and setting for the last several years. Some of the leading regulatory, financial, and monetary supervisory bodies have expressed concerns related to risk and challenges of stablecoins, such as global financial stability, systemic risk, comprehensiveness, and effectiveness of regulatory and supervisory oversight. So stablecoins have recently emerged and attracted the attention of both public and regulators around the world. While the crypto asset market remains modest in size and does not currently pose a threat to the financial stability, this may change with the advent of global stablecoins, as Dante mentioned, Libra and other projects that are currently taking place. That way, they seek wider adoption by incorporating features aimed at stabilizing their value and exploiting the network effects stemming from the firms promoting these assets. The market capitalization of stablecoins issued by the largest stablecoin issuers has increased over the past couple of years by approximately 5, 6, 7, sevenfold, and is evaluated today to exceed more than 150 billion of assets under management. The current market largely consists of few large US dollar-pegged stablecoins. It's important to mention that stablecoins are predominantly used to facilitate trading, lending, and borrowing of other digital assets, and represent a fundamental component of decentralized finance markets that deliver liquidity and settlement mechanics without the use of the currency and centralized financial systems.
Gueorgui, I don't see your slides. I'm not sure if it's...
I don't have slides, Jean-Marc, because I have anticipated the fact that I'll be able to speak for a very limited amount of time. So
okay,
I will be accommodating to the fact that I have a limited amount of minutes.
That's fine. Thank you.
Remaining, but I will circulate those, basically the narrative for the purposes of informing the audience once the session is finished.
Okay.
Thank you very much. So I'm just circling that, coming back to, it's important also to note that stablecoins also allow users to store and transfer value beyond the fact that they can be used also as a payment mechanism. And they are associated with other digital underlying assets, trading, lending, borrowing within the distributed ledger environment. And their aim also in becoming so popular is to basically reduce the need for fiat currencies and traditional financial institutions within that ecosystem. I would like to, and I'm very happy that Dante mentioned this, is that we're all overwhelmed by the current evolution and usage of stable coins, but it's good to mention from a lawyer's perspective that the stable coins, although they do have these the capacity to store and transfer value and be accepted as payment amongst parties, the legal tender aspect of the capacity for them to be accepted is something which is very important, and from a legal standpoint is the one that is decisive to distinguish them from CBDCs. And being a European lawyer, I thought that it would be interesting to consider also the opinion of the European Central Bank, and which has had the opportunity to remind that the legal tender of euro banknotes and coins is basically the obligation for everybody to mandatorily accept them. And another aspect is that they must be accepted at their full face value, which is not the case of all stable coins, and the power to discharge from payment obligations. And I think that this is also from a legal standpoint when we're speaking about stable coins, is that these three components and characteristics must always be kept in mind, so that we can very well distinguish the stable coins from CBDCs, or just more generally currencies that do have legal tender. So the design and structure of crypto assets that deliver functionalities of stablecoins can materially vary in legal, technical, functional, and economic features. They're very complex and comprise many interdependent functions and legal entities which are involved in the process of creating and circulating them. The European Union and several other countries have adopted a legal, regulatory, and supervisory approach based on economic functionalities and propose have adopted the approach where the purpose of the stable coins actually is governed by the substance over form approach, and the approach of regulating must be technologically neutral. Currently, the regulation varies between countries, and it's also true for the draft legislation of stablecoins across, for instance, the US, European Union, and Switzerland, and has an instance mainly in four principal regulatory fields, which extend beyond the aforementioned jurisdictions. Is that the issuance and circulation of stablecoins involves different kind of regulations which are related to money movement issues, to investment and trading, which is typically securities and commodities, banking issues by deposit taking, and also custody of the underlying assets, and virtual currency specific regulations. I won't have the time to address the various countries that have been mentioned, but I would like to focus on the fact that, to my knowledge, there is no specific enforced regulation today in any country that addresses stablecoins specifically. And this is a very important thing to mention, because whether it's in the US, whether it's in Europe, and we can have a long list of countries that are contemplating to regulate stablecoins. These regulations are currently in draft form. I would like to focus on the fact that the European Union regulation for regulating markets in crypto assets encompasses in its objectives the fact to regulate stable coins. And I would like to mainly focus on the two types of definitions that the draft MiCA regulation focuses on, which are the asset reference tokens and basically the e-money tokens. The distinction between the two is very important, because while both need to have a prior authorization in order to be able to issue asset reference tokens or e-money tokens, the environments under which the issuer is operating in these two cases is very different. So I would like to be very concise. Basically, the authorization regimes is very specific to the European Union, where we have a specific status of an issuer of crypto assets, which can be a legal person that offers to the public any type of crypto assets and admission of such crypto assets to a trading platform. So this is very interesting, because it's a specific regime where the prudential regulatory capital for such entities is limited to 350,000 euros and 2% of the average amount of reserve assets. The other option in order to regulate stablecoins and the people involved in their circulation and issuance is the electronic money token and the e-token. And the approach which is adopted by the European Union is to authorize actually either as a credit institution, which is more generally designated as a bank, or an electronic money institution, which is a license specific to the creation of digital money and its circulation payment systems. The importance is that the European Union has taken the approach where e-money tokens, the prudential capital for a credit institution is 5 million euros, which is a significant amount for a level entry field approach. And if the e-money token issuer decides to get regulated as an electronic money institution, then they basically have to have 350,000 euros of prudential capital. I think it's something which it is important to consider, because instead of creating a specific framework in order to support innovation and build up the industry in the European Union, the European Union has really taken an approach where it offers existing financially regulated entities to be able to extend the offer of their services to provide stable coins, whether under the form of asset-backed or just e-money token approaches. I will try to very quickly make a conclusion. There is the approach where there has to be a prior authorization by each member state of electronic money token issuers or asset-backed token issuers. We have some exemptions where the regulation is not applicable to issues that are under 1 million. And also there is a de minimis exception, qualified investor exemption, which apply for qualified investors and issuance of such stable coins which do not exceed 5 million within 12 months. Jean-Marc, if you like, I will be leaving the space for questions because I won't be able to cover the entire thing, but I'll be sharing the thoughts in more detail after the session today.
Yes, thanks a lot for your the overview of the legal aspects. So we understand that for stablecoins, there are many potential different laws depending on different countries. Not all countries have the same laws to be applied to stablecoins. It's not final. Some countries try to apply existing laws and to apply them in the digital world. So it's not yet all finished. There are some issues as well quite soon, especially from the US, for example, regarding the infrastructure bill, where decentralized finance might need to enforce know your customer, anti-money laundering. And as Lisa underlined, is that some crypto users, they believe in or they want full freedom and privacy. So in the year to come, in 2022, that's true that the issues of decentralized finance, where that use also stablecoins, might create some friction, and so we'll see as well which of these ones resist to some potential crash and in real production. So now is the time for question and answer. So I think if all the speakers, if you could show your video, then we can try to answer together the remaining questions. So we have in the Q&A in the tool in Zoom a few questions remaining. So the first one by Luis Aragonés Ferri is about monetary policy. So maybe Lisa, if you could maybe read the question and try to answer, or if you feel you can answer.
So we're talking about with the assumption that the US dollar, the US digital dollar, CBDC, and US dominated stablecoins will dollarize the entire economy. Its monetary policy is not designed to capture asymmetric economic shocks across geographies. Would a system based on dollar as a world reserve be an optimal system? Very good question. And currently, this is not just an assumption. This is true that the US dollar, digital or not, is the dominated asset to allow for international trade across jurisdictions, across geographies. And a system based on dollar as the world reserve will potentially not be an optimal system in terms of the various economic shocks that's not being addressed. So what we can see in these stablecoins, and that's why I want to show that these various monetary policies and its impact on stability, because step one is to figure out how do we peg stablecoins, how do we peg this new privately issued stablecoins to US dollar, and then step two is to figure out what are the other mechanisms that we can play around with to maintain that peg. And then step three is to figure out if there is a way that we can peg it to a global basket goods of services, or goods of services that includes the on-chain and off-chain world, to create more of a stable coin that is more usable, or that's more reflective of what the entire global economy is. That being said, this is a very long and difficult process. That being said, there's so many factors affecting it. Ideally, that's what the real utility would be. That's how the path would be. Realistically, with a lot of regulations aspects, as the other panelists have talked about, there are a lot of other things to consider, and to get to that path might take a longer time. The other panelists, do you have other things that you would like to add?
Dante, maybe?
Yeah, I do think, and this is one of these interesting counter narratives, right? That while some are arguing that the United States, when I say some, I mean, for example, the editorial board of the Financial Times recently put out an article saying the US is losing the digital currency space race because the Federal Reserve has not launched or isn't really anticipating launching a central bank digital currency. My counter argument is the exact opposite, is the fact that the majority of the stable coins in circulation, the good ones and the bad, reference the dollar, is already making the dollar the currency of reference. And so, not surprisingly, as with any digital twin, you end up replicating the conditions in the market as well. And so I'm not surprised at all that much of the trades, much of the economic activity supported in the crypto assets market is already dollar referenced, dollar pegged, or priced in dollars. So the question of a global neutral instrument, I think, is incredibly aspirational. We saw it come and go in prior lives, and we frankly see it playing out with IMF SDR, special drawing rights at the IMF, and others. That these types of concepts are very nice in a whiteboard with theory, but ultimately, in terms of how the market will move, I think the dollar has already fundamentally won the digital currency space race.
Okay, so let me maybe just then follow up about this because we don't have so many other questions. So what do you think about the digital yuan, right? Because from a CBDC point of view, so China has done a lot of work and spent a lot of resources, even from 2016. It has, for example, filed a number of patents, for example, for even the use of CBDC when in offline conditions. So, for example, even when you are offline, you could use CBDC. So, in case of of a natural disaster, when you don't have internet and data, when, for example, another case, if you have a war, then you could also they could use their digital yuan CBDC even offline. So they patented a good number of solutions many years before other countries started to even look at it. As you underline, I think in your presentation, I think it started around like 2019, where really, I mean, maybe due to Libra or actually it was at least other occasion to work on CBDC. They started to really try to do some pilots and so on. But to me, a country that has taken seriously digital currency as a strategic tool is China. So what would you say, or the other panelists also as well? You could underline or give your view.
Yeah, I'm happy to make an initial comment, and maybe Gueorgui also has some comments here as well. I mean, I do think, Jean-Marc, you hit the nail on the head, right? That the stakes are maybe less the economic backing and economic quality of the reserves backing stablecoins, and more the question of offshore versus onshore in many contexts. No central bank wants a very large innovation denominated in their current currency that's physically outside of their reach. I think that's just one matter for managing systemic risk with these innovations. But then the real issue is not so much whether it's a stable coin or not, or whether it even rides on blockchain or not. It's this question of how does value transfer around the world? Who controls the rails? The fundamental innovation is less to do with the economics or the cryptography. It's more the ability to transmit value at scale. And then, how answerable will those value transfer networks be to sanctions compliance, to KYC, know your customer requirements, and other sort of risk requirements the post 9/11 financial crime compliance framework, basically. I think that's the real issue, and that's the real sort of geoeconomic and geostrategic issue.
Thanks. So I think we are close to the end of the session. There is a final question. Is there any international limitation for who can issue a stablecoin, or is it just national limitation? So maybe Gueorgui, if you want to.
Yeah, thanks, Jean-Marc. Well, there aren't any limitations as such. What we are looking at here is more national regulations which are related to an international FATF virtual asset, AML and CFT regulations that Dante just mentioned, that the political aspects is to control the flows and make sure that the money isn't used for criminal sources or activity. And on the other side, we see the national regulations, they interact with the meaning where, as today, we do not have a specific regulatory regime which is specific to stablecoins. Most of the entities are regulated in the US because we speak about US, the USDC, and etc. They are either regulated as electronic money institutions or wire remittent entities. So this is just for the purpose of basically submitting all these organizations essentially to AML and CFT. And then on a second step, which is not the priority, to make sure that the assets to which these stable coins are pegged to are a reality, and to assess what is their value to avoid any kind of financial fraud or other schemes.
Okay, so thanks a lot for your answers. So we have answered most of the questions. So I thank you again, our three speakers, so Lisa, Dante, and Gueorgui. Just for some takeaways, so we have seen that there are more and more types of stablecoins, from reserves to algorithmics, and so we might have even new ones in 2022. From the legal aspect, so some countries are proposing and advancing their legal framework, some region as well. These legal frameworks might impact actually the current work of and use of stablecoins, because if they are used without KYC and anti-money laundering, they might have an issue in some jurisdictions, like in the US in 2022. And so these issues might also be the occasion for these stablecoins to check their resistance to crash, because the legal aspect might create some situation where even the existing cryptocurrencies could be under trouble, and so see if they achieve to maintain their stable value or not. Thanks a lot. So again, I just wanted to underline that then there is next session at 4 p.m. Geneva time, CET, on the interoperability of stablecoins. So please come back, and we hope you enjoyed our session. Thanks a lot again to Lisa, Dante, and Gueorgui. You can also follow up with them, I guess, with their emails or contacts that have been provided in the slides. Thanks a lot, everybody.
Thank you, everyone. Bye.
Bye-bye.
Thank you very much. Goodbye.